Welcome to the Retirement Made Easy podcast, a show created to be your go-to source for straightforward retirement advice. Best of all, it is presented in a language that you can understand. Here's your host, certified financial planner, Greg Gonzalez.
Hey, welcome to the Retirement Made Easy podcast. I'm Greg Gonzalez. Thanks for joining me today. This is episode number 195. And on today's episode, I wanted to have a discussion about whether it makes sense to have life insurance and keep life insurance throughout your retirement. Now, if you're a regular listener, you know that my name's Greg Gonzalez. I'm the founder of Retire Strong Financial Advisors out of St. Louis, Missouri, and we help people 50 and over plan for a successful retirement. And that's all we do. And over the past 2 weeks, we've had at least a half a dozen people, clients, prospective clients, ask this same question. Should I keep the life insurance that I have now? Should I buy new life insurance? Do I even need life insurance in retirement? And whenever a question like this keeps popping up over and over again, a light bulb goes off in my head and it tells me, hey, I should do a podcast episode on that very topic. So that's what I'm going to do today. We're going to talk about the ins and outs of, where it might be useful to have life insurance in retirement, how much you might need, because some people are overinsured or underinsured. And then those people that, hey, they don't need life insurance and maybe they are okay to cancel it or get rid of it. So we'll talk about that too. Again, I'm a certified financial fiduciary and I don't work for a life insurance company, so I'm here to tell you that there are some people that no longer have a need for life insurance. So we'll talk about people in that camp and what their situations look like. And my goal here today is to get you thinking about whether you should have life insurance, whether you should keep it. Do you have too much, too little? Because this question keeps coming up over and over again. And I was just talking to someone just yesterday that said, Greg, are we wasting our money here keeping this life insurance? It doesn't seem to me that we really have a need. So that's going to be today's episode. Hopefully you can learn a lot and get you really thinking about your situation. If you're a new listener, welcome to the Retirement Made Easy podcast. There are 194 previous episodes that you can scroll back and enjoy. And then we have free resources we make available on our website, like our tax planning guide, our Social Security guide, our retirement budgeting tool, our women's guide to retirement. They're all available for free on our website, retirestrongfa.com. And for those listeners out there that want to get serious with your retirement planning, want to speak with a team of fiduciary advisors, people who specialize in retirement planning, there's a form on our website, again, retirestrongfa.com. Fill out the form, and we start the conversation that way. Okay, let's jump into today's topic about, do you need life insurance in retirement? And in my experience, I've even seen couples quite regularly disagree on the answer to this very question. There's a lot of different factors, a lot of different variables that go into this discussion. So we're going to try to cover them all. Believe me, I have a list of different talking points on this question. So first off, I think we can all agree that there are certain people in different stages of life or seasons of life that may have a greater need for life insurance than others. For example, let's say we have a working spouse and a non-working spouse, and this nice couple has 3 adolescent children. Let's say this couple is in their 30s. Again, with one working spouse, they need life insurance. Let's say they've got a sizable mortgage. They may have student loan debt. They may have other consumer debt like credit card debt or auto loans, something like that. There's a lot of reasons here why they would need life insurance. And a lot of listeners of our podcast might be thinking of their adult children saying, hey, yeah, that's my son or daughter. They've got young kids who are my grandkids. And as parents, they need life insurance. And I think back, there was a kid that I went to grade school with. We played a lot of basketball together. He was a really good basketball player. And the 5th grade basketball coach was actually his father. The nicest guy you would ever meet. He worked hard. He was a family man, just a super guy, great coach, just treated everybody fantastic. And when we were in 6th grade, my friend's dad got in an auto accident and was killed. And just like that, in a blink of an eye, I remember it was around Christmas time, they had to sell their house. They had to move closer to family. All 3 kids got pulled out of school. Their mom was a non-working spouse, and their life was turned upside down in an instant. So again, that's a stage in life. Young kids, big mortgage, student loan debt, maybe only one spouse is working, the other one's raising the kids. That's a time in your life where a lot of people don't have enough life insurance. And for a couple like that, in that situation, Dave Ramsey, as a rule of thumb, always says 10 to 12 times your annual earnings is what you should have in life insurance. Now, there's cases where you would need more than that, and there's cases where you would need less, but that's kind of a rule of thumb. And Dave Ramsey would tell you that 20 to 25 years of term life insurance would be appropriate. Now, a lot of people have group life insurance through their employer. The benefit of that is there's no health exam. So for those people that maybe are uninsurable, that's a great way to get life insurance is with your group life insurance. And that will be, typically there will be a cap on how much life insurance you can purchase with your group life. Sometimes it's 2 times your salary. Sometimes it's 3 times your salary. Sometimes it's up to $1 limit, like $500,000. And typically you're able to have spousal life insurance coverage in that group life as well. Now, the danger with that is if you lose your job, it typically goes away unless it's portable. So you would want to check with your group life insurance, is this a portable policy? Meaning if I retire or I separate service, can I move it with me? Now, the benefit of group life insurance, in my opinion, is number 1, no health exam in most instances. And number 2, the cost, since you're in a group plan, is very, very affordable in most instances. But let's fast forward. Let's say, okay, we're a couple of years out from retirement. We're looking at our budget and we're saying, gosh, I'm still paying for this life insurance, yet my house is paid off. We've got no debt. We're completely debt-free. Our retirement portfolio, like our 401k, Roth IRAs, it's the biggest value it's ever been right now. Does it make sense to continue to pay for life insurance? Let's first consider the cost of the life insurance. If it is a few dollars out of your paycheck and it's group life, or you still have a term life insurance policy that hasn't matured yet, the cost is probably very, very reasonable. So in my opinion, that's what you've got to kind of factor in is, okay, what is this costing me? And if I did cancel it or get rid of it, what am I actually going to save? And if it's going to be $10 a paycheck, I think maybe if the coverage is significant enough, maybe that's something you hold on to until you retire. If the premium on the life insurance is minuscule, that's something that you've got to kind of say, hey, that kind of, yeah, I may not need that much life insurance, but since the cost is so low, maybe I keep that term life until it matures. That's a conversation that a lot of people have in their heads. Now, on the flip side, we have a prospective client that is paying almost $1,000 a month in permanent life insurance. The premium that they pay is about $1,000 a month in permanent life insurance. They have no kids. They have no charitable goals. Their mortgage is very, very low, and they're single, so there's no spouse that we're trying to protect. And typically why people have life insurance while you're working is to protect your future earnings. If you passed away prematurely, now your paycheck, your earnings ability is now off the table, and therefore the life insurance would kick in to cover those missed years of earnings. And the big benefit, one of the big benefits of life insurance is it pays out tax-free. So if you are the beneficiary of a life insurance policy that mom or dad had or your spouse had, it's totally tax-free. When you inherit the life insurance proceeds as a beneficiary of that policy, it's totally tax-free. But one of the big problems that I personally see with life insurance is it's oversold. And as a SmartVestor Pro, I am totally on board with Dave Ramsey's way of thinking that term life is far superior in about 95% of circumstances than permanent life insurance, which if you own whole life insurance, which the premium's about 20 times what term life is, 20 times higher, you do have a cash value. There's a bunch of surrender penalties. There's a lot of nuances with whole life and universal life and variable universal life. Those policies can be very, very complex. And a lot of people don't understand how they work, in my experience, and that's my opinion, of course. And they are oversold because the commissions on permanent life insurance are so much higher than term life insurance. And as a certified financial fiduciary, I have to point that out because that's a conflict of interest. And that's why so many people are sold whole life, universal life, indexed universal life, and variable life insurance. It's because the commission is that much higher than term life. So if you're one of those people that has had somebody try to sell you whole life or universal life or variable universal life, you know why they were so pushy. So let's talk about the situation for the people out there that maybe they have life insurance. Okay, so as we talked about, there's many different types of it. There's group life insurance that's available through an organization. Typically, it's going to be an employer, but sometimes if you're a member of a club or organization, there is life insurance that you can get. Then there's term life insurance that you buy. That might be 10-year term, 20-year term, 25-year term. It's a level premium that you pay, and then it matures at a certain date. There's no cash value. So if you have that, you need to look back at your policy and make sure you understand the premium you're paying and when it will mature. Because, for example, if you bought a 20-year term life insurance in 2005 and it's 2025 now, that thing is going to mature and the premium, should you want to continue it, is going to spike up. And you can ask them, the life insurance company, what that spike will be. And it will probably shock you how much the premium will go up. And then last but not least, many of you may own what I'm going to call cash value life insurance or permanent life insurance. That's going to be like a whole life policy, universal life, indexed universal life, or variable universal life. Those all have cash values. And it really all comes back to, okay, what is the risk here? If there were a premature death and you passed away, is your spouse, the surviving spouse, if you're married, going to be okay? Can they live on one Social Security check, a pension if you have it, and the assets, the retirement savings accounts that you have, the investment accounts? Will that be enough to sustain their lifestyle for as long as they live and live with dignity and independence? That's what it comes down to. Really backing into that and saying, okay, how much do we need? If we had to put a price tag on the rest of our retirement days, how much would we need to fund that lifestyle based on the goals and the retirement vision that we have? And if we don't have enough assets, meaning 401k money, retirement savings, then yeah, we probably need some type of life insurance to cover that gap. And what if there's a mortgage? What if there's student loan debt still being carried forward? Other types of debt. That might be a reason to carry life insurance, that if one spouse were to pass away, the surviving spouse could say goodbye to the banks. And what I mean by that is use the proceeds of the life insurance to pay off all those loans, the mortgage, the car loans, the credit cards, whatever it is. And then on top of that, still have enough to maintain the lifestyle that they want to have in retirement. Now, one of the challenges is, especially for the married couples out there, is if one spouse does pass away prematurely, now all the assets go to the surviving spouse, typically, unless it's in a trust or special situations where maybe the kids inherit some money. But typically, most of the assets would then go to the surviving spouse. There's one Social Security check, which that's a cut in income. If both spouses are receiving Social Security, one spouse passes away, now we go from 2 Social Security checks to 1 Social Security check. The other thing is the tax status changes, and now the widow or widower is going to be filing single tax status. That can be a bite. And what I mean by that is really cause your tax bill to escalate in a hurry. Now, there are other reasons to have life insurance in retirement. For example, I know a couple that keeps $1 million each of life insurance because one of their goals in retirement, when we were talking about their retirement vision, was to be outrageously generous to their church for all the good and blessings that church community had brought into their lives. And there's a lot more to the story, as you can imagine, but they were very, very adamant and passionate about this vision, this goal they had. And they keep life insurance of $1 million each. And the beneficiary of the life insurance policy for both of them is their church. And there's a lot of different strategies here. I'm not going to get into the specifics of it, but there's trusts like irrevocable life insurance trusts, there's charitable remainder trusts. But my point here is that sometimes life insurance is needed to make sure that we can reach charitable goals that we might have or philanthropic goals that we might have. And sometimes it's just not possible without involving a life insurance policy. And also legacy planning. That's another thing. There are some people that say, hey, we want to have X amount of dollars in a life insurance policy, knowing that they're assuring a certain amount is available to be left to any beneficiary. Maybe it's a son or daughter, family member, friend, whoever it is, and they know that that death benefit will be tax-free to the beneficiary. Now, some people will name their trust as the beneficiary of the life insurance policy. They'll name family members, friends, whoever it is, it will still be tax-free, whoever you name. And the other thing is it avoids probate. So we talked about having life insurance during your working years. And the purpose of the life insurance while you're working is to protect the ones we care about, the ones we love, by ensuring the risk that you would pass away prematurely. And if you pass away, well, that income and all of the future years of income goes away. So it's really protecting the family or the ones you love and care about who rely on your income for their financial sustainability. Now, in retirement, think about the income that you might want to protect with the life insurance. And for some people, they will have a pension in retirement, and that is a source of income. It's an annuity, which is a lifetime stream of income payments. And there's a lot of strategies out there. Some are called pension maximization strategies. They will actually pair or combine taking the pension option, the monthly pension option, with a life insurance policy. So if you were to pass away while receiving this pension, maybe your spouse would either have a reduction in the pension that they are entitled to and they receive for the rest of their life, or they would be the recipient of a life insurance policy, which is totally tax-free. And when you go to claim your pension, your particular strategy, even if you're considering a pension maximization strategy, it's going to depend on not only what the options are. For example, is there a lump sum option available for your pension? Some have that, some don't. And then what are the amounts as far as if you take the single life pension option or the 10-year certain, or if there's a spousal a survivorship option. Maybe it's 100%, maybe it's 50%. And the 50% option, all that means is it'll pay $1,000 a month while you're living. And if you were to pass away, your spouse would get 50% or $500 a month for the rest of their life. And then also considering your current health to see, okay, are you even insurable? Is life insurance even an option? Is it even on the table for your situation? And the one thing I will say about that is it doesn't cost you anything but your time to see if you're insurable, to apply for the life insurance. You can always say, hey, no deal. I got a different rating than I was hoping for, and I'm not going to move forward with the life insurance. That is an option. Keep that in mind. There is no cost to apply. And the last thing I'll mention when it comes to combining pensions with life insurance is you want to make sure you're pairing the right life insurance. So oftentimes we'll speak to somebody and they have life insurance and they explain how it works. and it's clear to our team at Retire Strong that this person was either misinformed on how the policy, the life insurance policy actually works and functions, or whoever they bought the life insurance policy from didn't take the time to explain how it works and functions for their benefit. And I know that's obvious, and I know a lot of people want to, buy their own life insurance and do everything online nowadays, but I've just seen it over and over and over where people, they don't understand how complicated these life insurance policies can be with riders and different nuances. And unless you really, really understand how the thing works, you might be disappointed down the road. Because these life insurance policies, they can be complicated, and there seems like there's endless options as far as choices of life insurance, not only companies, but also different policies and contracts that you can get into. So that's my word of caution. For example, I've had people say, oh, well, my life insurance policy is paid up. I don't have to pay into it ever again. And then as I review the policy, it's not. They were misinformed. This policy is not paid up. Certainly there are policies that will be paid up through a certain age. And that's something that you really, really need to understand and have a good grasp on. But circling back to my point here is for those people that have pensions, I would say it's fairly common that somebody pairs a life insurance policy with that pension, knowing that the pension will be adjusted once there is a death of the person that earned the pension. And they want to have that life insurance policy in place to protect the loved ones or the surviving spouse. Now, I want to switch gears for a second and talk to the people out there that might have permanent life insurance like whole life, universal life, variable universal life, and maybe there's a cash value that if you surrender the contract, the policy, that you could receive the cash value. Essentially, how that works is you want to do so, in my opinion, after you turn 59 and a half, if there is a gain. Now, of course, you'll want to talk to your CPA, your fiduciary financial planner. You want to have this conversation. Does it make sense to cash this thing out and surrender it? So what they do is they look at all of the total premiums you have paid into this. I'm going to call it a whole life insurance policy. And let's say you've had it for 30 years. You've been paying $1,000 a year into this thing. And so you have paid, your basis is $30,000. Let's say the cash value is $45,000. So you have a $15,000 gain. You paid into it $30,000. The cash value is worth $45,000. So the gain is $15,000. So I like waiting until, and I recommend considering waiting until you're 59 and a half because there will be no 10% penalty. Again, check with your CPA, your fiduciary financial planner on that to make sure it's a good idea. But in that instance, you cash it out and get your $45,000. There's going to be taxes on the gain, on the difference between the cash value and what you've paid into the thing, also known as your basis, and that $15,000 will be taxed as ordinary income. Now, you would want to speak with your tax advisor, your certified financial planner, to see how much you should withhold as far as taxes, because they will allow you to withhold taxes on the $45,000 that you receive. And if you're unsure of what the basis is, you'll have to call the life insurance company and say, hey, how much have I paid into this thing? They will be able to calculate that. They've received your payments all these years, and it may take them a while. They may send you a letter in the mail or send you an email, but that basis, what you've paid into the thing, that will be return of principal. So let's say you paid $30,000 into it, but the cash value was only $20,000. Well, you have no gain. So that's actually considered, that $20,000 cash value is considered return of principal. So there's no taxable event there. And in a lot of these policies that we review at Retire Strong, that's the case. There is not a gain. So you're just getting the cash value of what it's worth. Now, one thing I'll mention is you can also do, if there's a big gain, what some people do is they consider doing a 1035 exchange. You can Google, we'll put it in the show notes to kind of explain how it works. But let's go back to that example where you had the $15,000 gain. And so the $45,000, as long as you transfer it, do a 1035 exchange to another insurance product, either some type of life insurance policy or an annuity, you could do a 1031 exchange and you would avoid taxes. You would defer taxes. So that might be something you consider. And especially if you have a big unrealized gain there, that might make sense for you. Now, typically when I see a lot of these whole life insurance policies, the death benefit on the thing is like $10,000 or $5,000 or $25,000. And it's not enough to really make a difference in your overall financial life should you pass away. And I say that with care because I know that, a $25,000 life insurance policy 30 years ago in 1995, that was a lot of money. It was a lot more than today. And that probably, when you bought the policy, that $25,000 seemed like a lot of money. That could make a meaningful difference in the beneficiary's life. But 30 years later, in 2025, that $25,000 policy, not so much. So that's what I want you to do. Consider your situation. Look at your mortgage balance. Look at your other debts like car loans and personal loans and credit cards. Look at how much you have saved for retirement. And heaven forbid, if you passed away, considering all that, would your spouse be left in a situation where they would still have a comfortable lifestyle in retirement? And if not, you need life insurance, and you need to figure out how much life insurance would make that surviving spouse okay in a situation where this policy made sure that all the debt could be paid off and put them in a position for success. And I haven't mentioned this, but not only spouse, but also maybe dependent children, family members that kind of depend on you financially. And maybe there's a trust that needs to be set up. Maybe there's some more serious advanced planning that needs to go into this. But if you have any family members that are dependent on you financially, and you were to pass away, what kind of shape is that going to leave them in for the rest of their lives? And that's where life insurance could play an important role. And then we talked about legacy planning. We talked about charitable goals. And consider your situation. Why is life insurance necessary in your opinion? What goals do you have? What risk do you have if a premature death happened? What do you want this life insurance to cover? How would that tax-free life insurance death benefit be used? Who would it help? Is it your spouse? Is it your kids? Is it your friends? Is it your church? And so I hope after today's discussion, today's podcast episode, you'll factor in all these different variables, because these conversations that we're having with our clients at Retire Strong, oftentimes I'll hear, hey, we're debt-free. Our kids are doing better than we are. They've bought their first house. They're getting that paid off. Financially speaking, they're doing tremendous. They've got great careers. They are financially well off. They don't need to be the beneficiary of this life insurance anymore. But thank goodness we had it when the kids were young, when money was tight, when we had a big mortgage, and we were barely getting by. And one last point I want to make is consider your retirement vision, your goals. Your personal goals should drive all of your financial decisions and your planning. And oftentimes we forget that. For example, we are working with a client that has a life insurance policy because she is going to use the life insurance policy at her death to set up a scholarship. She has a family member who has agreed to run it, and that's an important piece of her legacy that she's planning on. She received a scholarship when she was in college, and she said it changed the trajectory of her life. She went into a career that she did very well for herself, and it would not have been possible without that scholarship that she received, and she's never forgotten that. So, moral of the story, Don't forget about your goals, and maybe life insurance can help you accomplish your retirement goals. I'll see you next time, and remember, always dream big.
Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. The content in this material does not necessarily reflect the views of LPL Financial. This is a hypothetical example and is not representative of any specific situation. Your results will vary. The hypothetical rates of return used do not reflect the deduction of fees and charges inherent to investing. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments might be appropriate for you, please consult your attorney, tax advisor, or financial planner prior to investing. This is a hypothetical example and is not representative of any specific investment. Your results may vary. All performance referenced is historical and is no guarantee of future results. All indices mentioned are unmanaged and may not be invested into directly. There is no guarantee that a diversified portfolio will enhance your overall returns or outperform a non-diversified portfolio. Diversification does not protect completely against market risk. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. Fixed and variable annuities are suitable for long-term investing, such as retirement investing. Gains from tax-deferred investments are taxed as ordinary income upon withdrawal. Guarantees are based on the claims paying ability of the issuing company. Withdrawals made prior to age 59 and a half are subject to a 10% IRS penalty tax, and surrender charges may apply. Variable annuities are subject to market risk and may lose value. Riders are additional guarantee options that are available to an annuity or life insurance contract holder. While some riders are part of an existing contract, many others may carry additional fees, charges, and restrictions, and the policyholder should review their contract before purchasing. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. Retire Strong Financial Advisors and LPL Financial are not endorsed by or affiliated with the United States Social Security Administration or any government agency. Retire Strong Financial Advisors and LPL Financial are not endorsed by or affiliated with the U.S. Centers for Medicare and Medicaid Services or any government agency.
Thank you for listening to the show today. Check us out at our website, retirementmadeeasypodcast.com. And if you want some help from Greg, submit your questions at the bottom of the page or sign up for a 30-minute retirement coaching session with Greg. We'll see you next week.